Hey gang, Dennis Tubbergen here. It is Thursday, March the 15th, 2018. I'm here with another video market update. Today I want to go back and revisit what U.S. government bonds look like. U.S. government bonds, obviously, as we talked about before, and as you see on the chart here, which is a daily candlestick chart, are in what appears to be a head and shoulders pattern. And if you haven't watched any of my prior video market updates, you may not know then that a head and shoulders pattern often appears at a market top or at a market bottom. It's often a reversal pattern. Here you can see the most recent trend in U.S. government bonds has been up, and we have a head and shoulders pattern here where we have the left shoulder, the head, and the right shoulder. And in order for a head and shoulders pattern to be valid, the head needs to be taller than the two shoulders. You have to have the shoulders that they don't have to necessarily line up exactly in height. So this is pretty much a textbook head and shoulders top pattern. However, if you take a look over here, and I can zoom in a bit, you see that yesterday U.S. government bonds had a big day. Yields declined. Now, that kind of flies in the face of the theory that this might be a head and shoulders top pattern. In fact, if you look at the weekly chart, you see the head and shoulders top becomes now a lot more defined. It becomes a lot more clear. The neckline becomes a lot more clear. And if you take a look here, we have a rally right up from the neckline. Now, the only issue here for this rally is that it is on very light volume. That might make it a bit suspect. So the head and shoulders pattern has not been discounted or ruled out at this point. However, there's some stuff going on in stocks that may make this an issue. If you go back and take a look at the two charts I have here overlaid, the top is a mutual fund that tracks the S&P 500. The bottom is a mutual fund that tracks government bonds. Now, the time frame on this chart is really March of 2008, and I really want to focus through 2009 or so, because that's the time when the stock market was really declining, and that's indicated here by this chart on the top. You see that there was a pretty significant decline, and then the market bottomed here in March, and then it took off and has been in a bull market really now for the last almost 9 years. As the market declined, as that decline intensified, you can see what happened to U.S. government bonds. They spiked, and that's because U.S. government bonds have typically been a safe haven. But a lot has happened in 10 years, fundamentally speaking. The U.S. dollar is falling out of favor around the world, and we're speculating, we're theorizing, if you will, that we may be seeing some alternative safe havens emerging. However, if you take a look at what stocks did yesterday, stocks declined across the board. The Russell 2000 declined. The NASDAQ, the Dow, the S&P 500. We've been saying that we think the most likely outcome here is more downside for stocks. It appears that may be playing out. Perhaps what we're seeing yet is the U.S. dollar and U.S. Treasuries having one last hurrah here as a safe haven, although it won't be as much of a safe haven as before. Long term, we think that on a fundamental basis and on a technical basis, we will see stocks decline, we will see the U.S. government bonds decline, and that will likely be bullish for precious metals. So that's a quick look at U.S. government bonds. Today is Thursday, March 15, 2018. I'm Dennis Tubbergen, and that is your video market update.